This case illustrates the power of estate tax planning by looking at 4 different scenarios, 4 different planning options. So I'd like to go through the assumptions first, and then we'll walk through each of these scenarios. So we have a married couple, spouse number 1. We're trying to keep this as straightforward and simple as possible. So we're going to have all assets in one spouse's name. So spouse number 1, we assume, has the entire $30 million. Let's just say it's the house, the car, the land, everything is in that person's name. Okay, the federal tax exemption that we're going to use is $15 million. And what I mean by that is that each individual is entitled to a $15 million exemption from estate tax on their estate. That amount is indexed and it changes periodically and goes higher. It's been growing from when I first started in practice. I think it was $600,000, grew to $1 million and held there for a while, then went up to $3 million, and now is at $15 million. So we have a $15 million exemption, meaning that you could pay 0 estate tax on $15 million of value. Okay. We have an asset that is going to appreciate, or these assets, we'll assume, will appreciate throughout the life of the surviving spouse another 50%. So it's going to start out at $30 million, and the first spouse is going to pass away. And then the second spouse is going to live for a few more years, and those assets grow to $45 million. So we have a substantial increase in the estate, in the surviving spouse's estate. Okay, so we're going to look at how the taxes will impact these estates or each individual based upon the first death and the second death. One more important piece of information to know is this federal estate tax. The tax rate is 40%, and that's a huge, imagine paying 40% on the value of the estates that otherwise would be going to your heirs. That's a huge tax bill. Considering the fact that you've paid income taxes your entire life and now they hit you with an estate tax on top of that, if your estate exceeds this amount of money. Okay, so let's now look at the 4 methods. Method number 1 is considered the outright transfer to the spouse. Here we do not have a trust involved at all. We're strictly leaving everything to the surviving spouse. Now, the IRS, or Congress and the IRS through the code, allows a surviving spouse to claim a 100% marital deduction, meaning that they do not have to pay any tax upon the death of the first spouse to die. So whether it's $30 million or $100 million, the surviving spouse can take a full deduction and pay 0 taxes on that amount of money. Now, at the second spouse's death, however, the entire amount, if they inherited $100 million and then they passed away, then at the second death, that is going to be taxed. Okay, in scenario number 2, we have the bypass trust, also called a credit shelter trust. And so what we're going to do is we know that there's a $15 million exemption that's available for each person who passes away. So why don't we utilize that exemption amount by creating a trust to have $15 million flow into this bypass trust, and it's going to bypass the second spouse's estate. So this is how it works. The $15 million amount is placed in an irrevocable bypass trust using spouse's number 1 full $15 million exemption. And the remaining $15 million out of the 30, the total 30 that spouse number 1 owns, the remaining $15 million is going to go outright to the surviving spouse. So instead of getting all $30 million into the surviving spouse's estate and having all $30 million taxed at their death, we're going to bypass the survivor spouse's estate, spouse number 2, with $15 million, and only let her have the $15 million outright, which would then be taxed in her estate. Okay? So all future appreciation in that bypass trust is going to be excluded from the surviving spouse's estate. So surviving spouse gets $15 million. The other $15 million goes into a bypass trust, and anything that continues to grow is going to be growing outside of her estate. Now, we'll see the difference it makes in taxes shortly, but hold that thought. Let's get on to this third scenario. and that will be the bypass trust, and add a Q-tip trust on top of that. So in this case, having a bypass trust, you're going to carve $15 million out and send that from spouse number one estate to the bypass trust. And then you're going to send $15 million to a Q-tip trust for the survivor spouse. Instead of that going outright to her, it's going to be held at a Q-tip trust. And so now we have two trusts for the surviving spouse. We have a bypass trust that receives $15 million and a Q-tip trust that receives $15 million. So as you can see how this is playing out, we're starting to add trust. The first one, number one, scenario one, has 0 trusts, all $30 million to spouse. The second one has a bypass trust, or one trust, 15 to the trust and 15 outright to the spouse. And then bypass trust plus a Q-tip, that's 2 trusts now, and we have $15 million going to each of those. And then finally, we have something called a portability only option, which means there are no trusts at all. And we're going to let all $30 million go to the spouse, surviving spouse. But we are going to find a way to preserve that exemption that wasn't used at the first death. Remember, each person is entitled to $15 million. In the first scenario above, outright transfer to spouse, we didn't use that exemption, and that spouse received all $30 million and the election wasn't made. So at her death, all $30 million was taxed. Now, if this had appreciated, everything above $30 million would have been taxed also in that spouse's estate. So we'll be able to see the difference in number 1 and number 4 when we get to the next chart on the next page. But now that we have those 4 methods or 4 scenarios, let's move on and look at some real numbers. Okay, starting with, I think, the worst case scenario is where we have everything going just outright to the spouse with 0 planning. Husband dies, spouse number 1 dies. That spouse had $30 million and passed away, and everything went to the spouse. Now the spouse has died. The surviving spouse has died. We see a $15 million exemption being used here. So fortunately, the $30 million, we're able to deduct $15 million because she has that exemption available to her. We lost it with the first spouse to die. This was an outright transfer to the surviving spouse. But as you can see, we have $15 million taxed at 40%. 15 carved out as an exemption, but there's 15 remaining, and that at the 40% tax bracket, that results in a $6 million tax on that amount. So we see what happened when there was no planning at all, a $6 million tax hit. Okay, ignore everything to the right. We'll look at it in just a minute. Let's move on down the chart here. Now, if we had simply hired an attorney and set up a bypass trust where we could have $15 million at the first death going into the bypass trust, and then $15 million landing in the surviving spouse's hands, then when that person passed away, there's only $15 million there, and we're subtracting the exempt amount. So there's 0 tax. $15 million estate, $15 million exemption equals 0 estate to be taxed. And so even though there would be a 40% tax rate, there are no assets to be taxed. Remember, a bypass trust was set up, and we have $15 million that was carved out, and it's no longer in that estate. Now, that bypass trust is going to go to heirs. You'll have $15 million going to the heirs, and you will have the surviving spouse's $15 million also going to heirs. But the fact is that you've had actually 2 exemptions that have been used. One with the bypass trust, and one with that she was able to use at her death when those assets then went to the heirs. Next, we have the Q-tip trust structure where you, again, have a bypassed, let me add that word, see if I can do that here. No, can't do it in this, but it's a bypass trust with a Q-tip added to that. So you actually have 2 trusts. And so instead of anything going outright to the spouse, you have $15 million to bypass and 15 to Q-tip trust. So that's $30 million being held in 2 separate trusts. The good news is that each trust is able to utilize the $15 million exemption. So again, we have 0 taxation because all $30 million is being sheltered through 2 trusts that qualify for the exemption, the 15 exemption each. Finally, we have the 4th scenario, which is called the portability only. And at first glance, you would think it's going to be like the outright to spouse scenario where everything goes to the spouse. Well, in this case below, we have everything going to the surviving spouse. So you think, oh my goodness, there's going to be a tax again. What is it, $6 million tax, 40% tax rate. However, when spouse number one died, as we stated above, I think we stated that in the facts. Let me go back here. Yes, the executor files to preserve the exemption. So if there's proper estate planning, the executor knew well in advance that when spouse number one died, they need to file a report saying, wait a minute, we want to hold on to the $15 million exemption for the husband who just passed away. We would like to hold on to that until the second spouse dies. And when she dies, we're going to combine those two. So we're going to have her exemption of $15 million, and we're going to have the $15 million that was available to the husband. We would like to apply both of those at the second death. And so that's why the chart looks a little bit different here. You have $30 million, and we're going to apply a full $30 million exemption because the executor, in this case, filed a document to preserve portability. That's what's different between this and the one up here. Up here, they did not preserve portability, so at the first death, they lost $15 million of exemption. And that's why there was a $6 million tax. So in any event, in all these cases, where we have the situation, scenario 1 through 4, only one of them really resulted in an estate tax, but it was massive. Look at this, $6 million is lost simply by failure to plan, by having a bypass trust established by an attorney, or the other two types of planning scenarios. Now, it gets worse when we look at growth of an estate, because as you know, when one person passes away and the other one lives a period of time, you could have assets that appreciate. They continue to appreciate. Let's just say it's a very successful business and that business stock just continued to grow and grow and grow. Well, in this case, it does grow. And the estate went from $30 million up to $45 million after the first death. So husband passes away, the estate exemption wasn't used, and the estate grew. So at the death of the second spouse, there's $45 million sitting in her estate. When that happens and she passes away, well, we can use the $15 million exemption that she's entitled to, excuse me, but we lost the first exemption, but we have $15 million. So when you apply the 45 minus 15 million, you're looking at $30 million taxed at 40%. 4 times 3 is 12, right? 40% times $30 million. There's a $12 million tax bill now that has hit that second estate because of the growth that occurred and lack of tax planning. Now, let's move to the bypass trust, where we just add one trust and we apply that $15 million. So here we have assets growing outside of the estate in the trust. Okay, so she has some assets that grow. Hers grow from 15 up to 22 million. The bypass trust has assets that grow from 15 to 22 million. But the good news is that the assets that are appreciating in that bypass trust are able to avoid taxation on that growth. And so what you have then is, after you use her exemption, you're looking at a $3 million tax bill because of the growth that occurred in her estate alone. Okay? Now, adding the second trust, essentially the same result, where you add a Q-tip along with the bypass together. You have each trust is able to utilize the exemption, and so you still have a $3 million gain $3 million in tax because of the appreciation that occurred in each of those trusts when the property is ultimately distributed. And finally, we have the portability option, which, although it is an improvement over number one, where there was a $12 million tax, still all of the appreciation, the $15 million from the $30 million up to the $45 million, as you can see, when it was at $30 million, we were able to utilize $30 million using both exemption amounts. But here we have assets growing. And because of that growth, we had a full $15 million taxed at 40%, which amounted to a $6 million tax bill. So still, using the trusts show that there's a huge improvement over both the portability as well as the no planning scenario. So this is where the value of an estate tax planning attorney and financial planners who understand how these trusts operate and how they can work together to reduce taxes. This is where it's really well worth the cost to hire individuals who can help clients navigate, especially when they have the estates of this size. Now, what do I expect in terms of you as an MBA student in understanding these trusts and these numbers? Just be aware that without planning, it is probable and likely that exemptions that are otherwise available to spouses may be lost. Huge exemptions, and in this case, we were showing a $15 million exemption that was wasted in the first case here. While that exemption was preserved in the portability only case, that still did not deal with the appreciation that happened in the second spouse's estate. So there was still a hefty tax bill that had to be paid because we did not have trusts that were able to fully utilize both exemptions at the appropriate time and keep that appreciation out of their surviving spouse's estate. So to summarize, without estate planning, we could have significant estate tax bills, both at the federal and state level. Number two, by utilizing trusts, we're able to bypass or carve out some assets and have them grow outside of the surviving spouse's estate so that future appreciation will not be taxed in the second spouse's estate when they pass away, thereby saving a lot of estate taxes. And then finally, portability, using the portability option can be good if there is no appreciation at the second death, but typically there is future appreciation in estates, and the portability option may not be as good as using trusts in order to have comprehensive estate tax planning. Okay, we'll stop there. That's all I expect you to know from these slides. Hopefully you learned a little bit about the estate planning process and how significant dollars can be saved or lost depending on the techniques that are used. Thank you, and please send me an email if you have any questions.